Hello everybody and welcome back to GMD Investments. In the first part of the video we was looking at the balance sheet, but today we're going to be looking at the income statement. So as you can see on Google's income statement, at the very top you have revenues. Now the revenue is basically the cost of the revenue plus the gross profit. That's basically how you calculate the revenue. So if we come below, you have the costs and expenses. Now looking at the revenue still, just because a company has a lot of revenue, it doesn't mean that it's actually earning a profit. So we need to deduct the expenses of the business from its total revenues. So we would do the total revenues minus the costs and expenses, and that would basically get us our net earnings. So we need to really dig through the expenses to see, because the less money they're spending on costs and expenses, the more money they're making, really. So that's we need to really be looking through that. Okay, so moving on to costs of goods sold, which is also known as costs of revenue, that as we can see comes right under the total revenue on the income statement. Basically, it's either the costs of purchasing the goods the company is reselling or the cost of materials and labour used in manufacturing the products it is selling. So we should always investigate exactly what the company is, including its calculations of its cost of sales or cost of revenue. This basically gives us an idea on how management is thinking about the business. Right, so something we can actually do is find the gross profit. Now, the way we do that is by subtracting the total revenue from the cost of revenue, and that will get us our gross profit. So gross profit is basically how much money the company made off the total revenue after subtracting the costs of the raw goods and the labour used to make the goods. It doesn't include such categories such as sales and administrative costs, depreciation, interest costs of the running business. By itself, gross profit tells us very little, but we can use this number basically to calculate the company's gross profit margin, which can tell us a lot about the economic nature of the company. If to find companies with excellent long-term economic sort of competitive advantages working in their favour, a higher gross profit margin is considered. So if we look at companies like Coca-Cola, it has a gross profit margin of 60% or better. Moody's 73%, Wrigley 51%. In comparison to companies that have poor long-term economics. So if we look at stuff like United Airlines, 14%, General Motors would be 21%, US Steel, 17%. So basically, I would say a very general rule is companies with a gross profit margin of 40% or more tend to have some sort of competitive advantage. And these are the companies that we need to look for when we want to invest and get them good returns over the long term. To be on the safe side, we should track the gross profit margin across 10 years to ensure that consistency is there. And to be fair to you, across sort of everything we're looking at today, that is the key, is to look across several years. We really want to see them trends and that, because once we see that, they're keeping this trend over a long period of time, that's where we can truly see that they hold that competitive advantage over the rest. And that's really the most important thing. I mean, anyone can, we can look across a year because business is always sort of fluctuating and changing, and they can have good years, bad years, but we need to see that they're capitalising off both good years and bad years because, like we said, they have that advantage over the rest. They have that pricing power, which is probably the most important, is pricing power, and the nature of the business is just there, really. One thing I'd like to actually add on, because we are obviously looking at Google today, Google's gross profit margin is 56%. If we look at Microsoft, which is a company, kind of a competitor, theirs is 69%, and Apple comes up at 44%. Okay, so moving on to operating expenses. This basically includes, as we can see on the income statement here, research and development, short for R&D, sales and marketing, and general and administrative costs. So the selling, general and administrative expenses basically include management salaries, advertising, travel costs, legal fees, commissions, all payrolls, costs and the like. With a company like Coca-Cola, the expenses run into the billions and have a tremendous impact on the company's bottom line. With SGA costs, we are looking for consistency to show signs of a competitive advantage. Also, the lower the SGA expenses, the better. In the world of business, anything under 30% is considered fantastic. Most companies with durable competitive advantages are in the 30 to 80% range. If we see anything consistently at 100%, we are probably seeing a company in a highly competitive industry, and this is something we probably would want to stay away from. When looking at research and development costs, companies that have to spend heavily on R&D is probably not a good thing, as they're always putting their long-term economics at risk, trying to get the best technological advances. Basically, we want to stay away from this action as it eats away at the gross profit. When looking at other expenses, one is called depreciation. Basically, all machinery and building eventually wears out over time. This wearing out is recognised on the income statement as depreciation. Basically, the amount that something depreciates in a given year is the cost that is allocated against income for that year. Depreciation consistently kept below 10% is what we generally look for. Another thing I would like to quickly look at is something called EBITDA. This is short for earnings before income tax, depreciation and amortization. I think when looking at this, you've got to be quite careful because this can be kind of deceiving and manipulative. Actually, an investor called Charlie Munger, which is the right-hand man to Warren Buffett, which is the owners of Berkshire Hathaway, he actually calls this bullshit earnings because it's, like it says in the name, it's earnings before income tax, depreciation and amortization. So you're excluding all of them just absolute essential expenses. And like I said, that's why it can be very deceiving and manipulative. And there's actually a few case studies where people on Wall Street have used this in very clever ways. So we're in another video, we'll dive into it more into detail and we'll give you more of a breakdown on what this actually means. Interest expense is another type of expense. It's the entry for the interest paid out during the quarter or year on the debt the company carries on its balance sheet as a liability. Interest is reflective of the total debt that the company is carrying on its books. Companies with higher interest payments relative to operating income tend to be one of two types: a company that is in a fiercely competitive industry, or a company with an excellent business economics that acquired the debt when the company was brought in a leveraged buyout. I desire interest payouts of less than 15% of its operating income. Income before tax is a company's income after all expenses have been deducted, but before income tax has been subtracted. Talking about income taxes paid, American corporations have to pay taxes on their income. So today in America, that amount is approximately 35% of their income. Now, what is interesting about income taxes paid is that the line reflects the company's true pre-tax earnings. Sometimes companies like to tell the world that they are making more money than they actually are. Firstly, see what they are paying in income taxes. Take the number they list as pre-tax operating income and deduct 35% from it. If the remainder doesn't match the amount the company reported as income taxes paid, then we had better to start asking questions. If they're willing to try to mislead the IRS, then they're probably hard at work misleading their shareholders also. After all the expenses and taxes have been deducted from a company's revenue, we get the company's net earnings. We want to see if the net earnings are showing a historical upwards trend. A higher percentage of net earnings to total revenue shows its durable competitive advantage amongst the rest. For examples, Coca-Cola being 22%, Moody's 31%, but then companies without a competitive advantage, being General Motors, is 3% on even a great year. So anything higher than 20% is what we generally look for. Okay, so when looking a little bit further below, we come to per share earnings. This is the net earnings of the company on a per share basis for the time period in question. This is a big number in the world of investing because as a rule, the more a company earns per share, the higher its stock price is. So to determine the company's per share earnings, we take the amount of net income the company earned and divide it by the number of shares it had outstanding. A per share earnings figure for a 10-year period can give us a very clear picture. and consistent upward trend over a 10-year period shows us it has some kind of competitive advantage working in its favour. Large fluctuations of per share earnings over a 10-year period going up and down dramatically is what we should stay away from. It shows us that it is in a highly competitive industry that is prone to boom and busts. Okay, so that really concludes the talk on the income statement today. I mean, as you can see, if I sort of pull up, you might be thinking, oh, what is all this stuff you're leaving out and you're not really talking about? And these videos, the purpose of these videos is really for beginners. It's for people, because I think that the videos I'm seeing on YouTube today is not like, people can't relate to it because you need to start at the beginning. You need to understand what these mean, and then you can work off of these, and you can find certain percentages and ratios and, all their macro trends that you can dive into, and you can look further more in depth in the business. I mean, if we come down, you can start looking at YouTube, the revenue that they get from YouTube, ads, Google network, Google advertising. You can really go into depth and how they make money, and there's so much other things that you can look into as well. So this is really just the outline, the base. This is the most this is the starting point to what you should be looking at. The most important things to look at and to be focused on, and to understand what really is going on, and how business works. Because like I said, you can't be a stock picker without knowing these things and knowing how to analyse financial reports. And, people like Warren Buffett and Charlie Munger, they are reading, pages and pages of annual reports every single day. All that Warren Buffett does is sit down and he just reads annual reports. He reads and reads and reads. He keeps up to date with the news, and just annual reports is the rest of his work, or, 4K or proxy statements, wherever it may be. That man is just reading reports from businesses, because that is the nature of the game. So anyway, I hope you enjoyed the video. The final part of the video will be on the cash flow statement. So I'll be going through that on the third part. And yeah, so till next time.